In this video, I'm going to compare and contrast index funds, ETFs, and mutual funds so that you can make the best investment decision for your needs. Hi, welcome to my video about index funds versus ETFs versus mutual funds. The goal of this video is to help you understand the differences between these three types of investments so you can make an informed decision on which one is best for you. But before we get into the specifics, let's talk about why it's important to understand the different investment types out there. Before moving ahead, welcome to our channel. Make sure to subscribe to our channel and hit the notification bell so you never miss an update. Now let's get back to our topic. What are index funds? Index funds are a type of mutual fund that aims to match the performance of the securities listed in a given market index. Index fund investors can benefit from lower costs, such as no sales charges and fewer transaction costs than they would pay when buying individual stocks. Index funds can offer attractive returns over time, although potential short-term investments may boost higher yields. Index funds are passive as these funds do not require active management and instead simply track an established market index. Index funds can make for good investments for beginner investors as well as experienced ones looking to diversify their portfolio or lower overall risk exposure. What are E.T.F.s funds? E.T.F.s, exchange-traded funds, are funds that provide people a way to invest in a broad range of asset classes, such as stocks, bonds, commodities, currencies, and more. E.T.F.s provide investors with the ability to diversify their investments while possessing the same advantages of trading individual stocks. E.T.F.s are passively managed, which means they are not managed by an active portfolio manager. They generally track an index such as the S&P 500 index, allowing ETF investors direct access to specific stock market segments or industries at a low cost. ETFs can also be used as an easy way for novice investors to enter the investing world without having much initial capital and knowledge. ETFs typically come with low expenses compared to actively managed mutual funds, making them attractive to almost any type of investor looking for quick and easy entry into investment markets. What are mutual funds? Mutual funds are a great option for investors looking to diversify their portfolios who may lack the knowledge or experience to invest in individual stocks. Mutual funds are created by combining investments from multiple individuals and investing that combine money as a group. Typically, mutual funds are managed by professionals who specialize in certain markets such as energy or technology. Mutual funds pool investors' money into one portfolio and shares of the fund can be purchased at any time by investors. Investing in mutual funds is made simpler because an investor does not have to pick out specific stocks and manage the portfolio on their own, which can save considerable time and effort. Mutual funds also tend to provide better returns than traditional safe investments like cash or government bonds over long periods. Index funds versus ETFs versus mutual funds. What's the difference? Investment vehicles exist in a variety of forms, each having its own set of advantages and disadvantages. When it comes to index funds versus ETFs versus mutual funds, what is the difference? Index funds are portfolios of stocks and bonds respectively that track a benchmark index such as the S&P 500 or Dow Jones Industrial Average. ETFs, exchange-traded funds, are also portfolios that afford a great deal of flexibility for investors. But with ETFs, you can buy and sell intraday just like other stocks on an exchange-traded basis, making them easier to buy compared to mutual funds, which typically require more money up front, even if they don't have transaction fees. Lastly, mutual funds are baskets containing individual securities with an assigned focus such as technology or healthcare going forward. However, what mutual funds lack in liquidity, when compared to index funds and ETFs, they make up for with professional management and diversification. Which is better? Index funds, ETFs, or mutual funds? When deciding between investing money in an index fund, exchange-traded fund, ETF, or mutual fund, it is important to evaluate your long-term financial goals. Index funds invest in the same assets that are included in a stock market index like the S&P 500 and provide broad market exposure but usually have fewer costs associated with them than ETFs or mutual funds. ETFs also provide broad market exposure and may also include specific sectors or niches, such as technology or healthcare, as well as commodities. Mutual funds vary widely depending on their asset types and can be actively managed. Understanding which option best fits your needs can be tricky. It is wise to speak with a financial advisor who is familiar with the differences between these three types of investments and who can help assess which investment type is right for you given your risk tolerance and long-term objectives. Risks and benefits. When deciding which type of fund to invest in, it is important to understand the risks and benefits of each option. Index funds and ETFs are relatively similar investments with lower risk than mutual funds due to their passive investments in specific securities. Mutual funds involve a more active management style where an advisor actively changes investments to increase returns. All three can be good options depending on your investment goals, but there is no one-size-fits-all solution as each type of fund has its unique risks and benefits. Be sure to do your research before deciding which type of fund you will use for your investing activities. Alright everyone, we hope you enjoyed watching. Please make sure to like and share with others. Also, do let us know in the comment sections about your views. We will meet you in the next video soon. Until next time, it's goodbye for now.